Good afternoon and welcome back to the latest edition of the InvestTalk market analysis for the week ending July 15th, 2022. I am Justin Klein and I appreciate you all tuning in to this channel as well as our podcast, InvestTalk. And this week I'm going to title the video, Markets Rally on Bad News. And it's kind of a tell within the professional ranks that when bad news hits and the market doesn't fall, that's a pretty good tell that the sentiment is washed out either on the broad market or a particular stock. And you kind of saw that in the broad market this week. And so let's dig into the numbers. And Wednesday was the much anticipated CPI number that came in at about 9.1%, an acceleration from the May number. But the core CPI that actually decelerated from about 6 to 5.9. Not in a big way, but it's showing that if you strip out that food and energy, which clearly, there's problems with the war in Ukraine, embargoes, restrictions on certain types of trade in that space, that there's going to be volatility there, and we've seen that. So what's more important, though, is how are prices underneath the surface evolving as the economy weakens. And clearly the core CPI number showed a bit of a deceleration there. And basically now 3 months in a row. Yeah, so we were at 6.44 and the month of March, 6.13, 6.01, and now 5.91. So that's 3 months in a row where inflation has decelerated on the core side. Now, the higher headline number of 9.1% certainly should have spooked markets, and it did for a minute. And what you see here, this is the from the CME group, and this is the odds that the bond market is putting in of a certain rate hike for the end of this month. And for a short period, it was up to 100 basis points. So the odds on the right are the 100 basis point hike, because this is where we're at now, 150 to 175, and going up to 250 to 275. Well, that briefly went over about 80% by the close of Wednesday. Yesterday, you can see where it closed back down to about 44%. And now today, you're down to about 31%. Now, that's still a lot higher than we were at the beginning of the week, when we were at 92% odds that we were going to get a 75 basis point hike at the Fed meeting later this month. Now it's down to 69 on that side and 31%. So certainly the odds of a tighter policy in the near term increased, and the market kind of took it in stride and really rallied pretty strong today, which we'll get to in a minute. Now, some other numbers that came out yesterday, PPI numbers, pretty similar to the CPI. Remember, this is the producer price index that accelerated on the broad index, and then the core CPI that decelerated for now the 3 months in a row as well. Now, initial jobless claims, that was hovering in the month of June, kind of around that 230 mark. Now we hit 244,000, which would be a high for the year. And it just shows you that the labor market is also showing some near-term weakness. Industrial production came out, shrinkage of 0.2%. So certainly that's an issue. And then import prices, that was down your second month in a row of deceleration. Third month. 1, 2, 3. There we go. Yeah, I'll go to a 1 year chart on this. There you go. 1, 2, 3. So that's 3 months in a row where underneath the surface, prices are certainly coming down, or the growth of prices. Let's say the growth of prices and inflation are coming down. Export prices also tick down a bit on the back of the strong dollar. So that's where we're at on the economic numbers, but let's dig into the charts real quick. And we'll start off with the NYSE. And I talked about how this was major support. Here's the monthly chart. You have this fib retrace into this breakout area, 382, the 50-month moving average. All of that should provide some pretty good support near term, and it did, and we've double bottomed. And today was a nice reversal candle off of that sell-off on yesterday. So to me, this is showing the fact that the market's hanging in there despite the bad news on tighter monetary policy, a higher inflation, a weakening jobs market, etc. We're not getting a breakdown. All those are reasons for the market to break down, including earnings. Yeah, JP Morgan had bad earnings yesterday, which I'll show that here. and that reversed. It's already higher than it was at the close of Wednesday. And then companies like Citi and JP Morgan, or not JP Morgan, Bank of America, those are all breaking out as well. And it just goes to show you that sentiment is pretty washed out at this time. And I want to pull up the VIX as well. And I talked about how, is this going to continue to trend higher, or are we going to break to a lower low? What's interesting here is you had this little reversal off of last week's low, and you close this week below last week's low, right at that 200-week moving average, or day moving average. And the next question is, can we close below the low for June next week? Something else I'm watching, because this has started to make a series of lower highs after making a series of higher highs. And that typically is the start of a pullback, and trending lower volatility is bullish for the stock market overall. Now, everyone's focused on interest rates in the 10-year. And another interesting tidbit, higher inflation did not break out rates. In fact, rates for the week actually came down just a bit on the 10-year. Now, the short-term rates did go up a tick, but very modestly. The yield curve got a little more inverted, etc. But this still, to me, is setting up for a larger reversal to where the Fed is going to pivot later in the year. Something I'm on watch for, and that will certainly buoy the markets overall. The dollar, another one of those ones where, we had a nice move higher on Monday, but we closed basically flat from where we opened on Monday. So a little bit slowing momentum on the dollar to the upside. And let's look at IWM to the SPY. If the market was really going to break down in earnest, you'd probably see small caps breaking down. Well, the sentiment in small caps are washed out, and this is a nice little bull flag pattern here. Move higher in the month of May and into early June, and just consolidating right below that 100-day moving average, I think ready for a move higher. And you're also seeing some relative strength in ARC, now above the 50-day moving average, looking bullish near term. Now, this isn't saying, you should go buy all of these names and over the long term. I think what we're seeing here is a bear market rally. And bear markets rally can be swift, they can be powerful, and they can last many weeks and many months. And that's certainly possible in Q3. So just be on the lookout for that. Now, GLD, gold broke down this last week and kind of had a bit of a fall through this week, but you're into some major support. And I'm also watching things like the GVZ, which is the gold volatility index. This should be breaking out if gold is really gonna have some trouble. And if the 10-year does reverse, that's certainly going to help gold prices overall. And another indicator as well is GDXJ to the GDX. So the junior miners are showing a reversal here. I'm seeing a reversal pattern here. And if there's really a risk off of in the gold space, that's not going to happen. You're going to see a continuation breakdown of the junior miners over the majors. So something I'm on watch, and we're looking for a cycle low in gold prices in the near term. I want to look quickly at the bond markets as well, the corporate bond market. You're seeing a reversal in HYG to the IEF. So these are bond spreads. So junk to the IEF. So if this is going up, remember that is risk on sentiment. If it's breaking down, that means yield spreads are widening and bad things are being priced into the overall bond market. And you can see here, if you go to options, adjusted spread, option adjusted, there we go. So this is the corporate master option adjusted spread, and it's certainly gone up over the past year or so, but you can see we're not anywhere near kind of crisis levels. Okay, this is where we were in 2008 all the way up to 6. We were at about 3 on the COVID crisis. Now we're at 1.6, kind of where we were, in let's see, mid 2019 or early 2019. Okay. Market wasn't breaking down. We weren't going into recession. But what you could see is the economy was weakening at that time. And so it's happening here as well. So the bond market isn't flashing huge signs of weakness on the credit side. And it's showing a pretty strong indication that at least we're going to get a near-term bear market rally. Does that mean it's one to buy? Well, we shall see, or buy for the long term. We'll see. We'll see if this is the ultimate low of the bear market. That's certainly possible. How dovish does the Fed get? What kind of, how quickly does inflation cool off? If it cools off fast enough, well, we could be back to easing rates by early next year, and that certainly would be good for asset prices overall. So that's my take for the week. Very interesting one in the fact that we did not break down on bad news, and you want to take note of that. So I want to remind you that the contents of this video are for educational purposes only. They should not be construed as financial advice and should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KP Financial or those associated. I thank you all for tuning in and have a wonderful weekend.